A stock order can enter the market and return within seconds at a less favourable price. While the screens display calm quotes, the real action unfolds within server rooms and data cables. Today's trading has transitioned from the chaos of shouting on trading floors to high-speed computers operating in secure data centres. Once machines dictate execution, even the slightest timing differences can be exploited for profit based on others' intentions. This issue is crucial because long-term investors incur hidden costs through wider spreads and missed opportunities. It matters because trust erodes when the public cannot understand how trades are executed. Imagine a portfolio manager placing a significant buy order only to see offers vanish as the first shares are executed. The manager is then forced to pursue higher prices, even though there has been no change in the company's value. In this video, you'll witness how speed incentives and market design interplay, as well as which solutions genuinely mitigate abuse. The ideas of this discussion are inspired by the book Flash Boys by Michael Lewis. Subscribe for more insightful market analyses. The stock market isn't just one location, it's a network of venues interconnected by rules and routers. When a single order is divided across multiple exchanges, each fragment sends signals that can be exploited by others. High-frequency trading involves utilizing computers to execute trades rapidly, capitalizing on small price discrepancies. The advantage lies in processing market data faster and reaching the next venue before slower orders can catch up. Fragmentation increases cost because the best displayed price might vanish before the full order arrives. It also adds complexity, as brokers must determine where to route orders, with routing decisions impacting outcomes. An institutional trading desk may aim to purchase 50,000 shares, but only a small quantity may be available at each venue. As the first portion executes, other venues react, causing the remaining portions to face higher prices right away. This situation transforms execution into a timing challenge rather than a simple assessment of value. A proactive approach includes inquiring about the venues your broker utilizes and the measures they take to shield large orders from signaling. Predatory strategies concentrate on latency arbitrage, making profits by being the first to respond to newly available information. Latency arbitrage occurs when one venue updates a price before others, leading slower participants to trade on outdated quotes elsewhere. A trader at a leading bank discovered that his orders often move prices against him, even for ordinary liquid stocks. He realized someone was detecting his initial fill and racing to other exchanges ahead of him. This resulted in persistent slippage, where the same order cost more simply because it was executed in visible fragments. The team developed software that synchronized routing, ensuring each exchange received the order nearly simultaneously. When the order arrived together, fast traders had less opportunity to intervene. This illustrates that fairness can be enhanced when information is not compromised due to uneven timing. One effective next step is to utilize tools that reduce routing delays and minimize exposure to outdated quotes. Additionally, evaluating execution quality is essential by comparing expected prices with actual fills across different venues and times. Exchanges compete fiercely for orders, and they've adapted by incentivizing brokers to direct trades to them. The maker-taker model incorporates fees and rebates, allowing venues to reward specific order flows effectively. Brokers may route orders to capture rebates, even if another venue could provide better execution for the client. This conflict intensifies when exchanges also offer fast data feeds and exclusive access to their systems. Complexity has increased through specialized order types, allowing certain traders to bypass queues or conceal their intentions. When investors see a displayed quote, they assume it's genuine, but order rules can alter who actually receives fills. Dark pools have introduced another level of complexity, enabling large banks to match orders internally while benefiting from hidden spreads. In some pools, slower participants may be disadvantaged, as faster traders anticipate their direction and react first. Addressing this issue requires simplifying rules, minimizing routing payments, and ensuring clearer accountability for execution. If this breakdown enhances your understanding of order mechanics, consider subscribing to continue exploring these concepts. An alternative approach is to redesign the market so that speed advantages do not dictate outcomes. A newly established venue introduced a small delay to uniformly slow down all incoming orders. This delay, referred to as a speed bump, ensures all traders experience the same pause before execution. Engineers achieve this pause by integrating a lengthy coil of fibre optic cable within the matching system. The aim was to prevent electronic front-running, where faster traders can predict slower orders and trade in advance. With the implementation of the pause, the venue could adjust prices and shield investors from outdated quotes across fragmented markets. Large managers could execute a buy or sell without leaving a detailed trail across exchanges. Critics claimed that any delay constituted manipulation, while supporters viewed it as levelling the playing field for execution access. A key lesson is to design rules that make profitability reliant on providing liquidity rather than exploiting response times. Another important step is to select brokers and venues that uphold commitments to equal treatment and transparency in routing decisions. As microseconds gained significance, firms heavily invested to reduce the distance between Chicago and New Jersey. They acquired faster network hardware, leased optimal routes, and constructed new connections to eliminate minuscule delays. One initiative established a more direct fibre route, significantly reducing travel time for market data and orders. Another wave of innovation utilised microwave relays through towers, since signals travelling through air can be faster than through fibre. These investments were crucial because being the first to act could mean seizing the best price before competitors can react. This increased expenditure also shifted market power toward firms able to invest in networks, legal expertise, and continuous improvements. For many, the market appears liquid, but the quality of execution varies based on unseen factors. A market characterized by rapid transactions often prioritizes short-term gains over meaningful investment strategies, research, or sustainable ownership. The optimal solution lies in aligning incentives so that achieving speed is less critical than fostering honest transactions. Progress becomes more visible when execution rules are clear and uniform for all participants. A fair market isn't merely defined by catchy slogans. It relies on robust rules that prevent manipulation. Speed, rebates, and concealed order protocols can turn typical investing into a perpetual disadvantage. You witnessed how fragmented trading venues generate signals and how latency arbitrage exploits those signals while harmful incentives multiply the negative effects. You also recognize that minor delays and simplified access protocols can mitigate predatory timing strategies. Over time, fairer execution reduces hidden costs, allowing long-term decision-making to outweigh microsecond tactics. This approach also restores confidence that prices genuinely reflect supply and demand rather than benefiting a privileged few. Begin by understanding how your broker handles order routing and what safeguards are in place for large or sensitive trades. Evaluate trading venues based on transparency, execution quality, and the potential influence of payments on routing decisions behind the curtain. When the rules and incentives are transparent, it becomes significantly more challenging for fast actors to silently siphon off value. Subscribe for more actionable insights on identifying better market structures and advocating for fairer